Hello, and welcome to the Certified Equity Professional Exam Overview webinar for Level 2. My name is Pam Chernoff. I'm the Curriculum Coordinator at the CEP Institute. This segment of the Level 2 webinar is focusing on equity plan design, analysis, and administration. We're providing this webinar to assist in your exam preparation process. This Level 2 webinar is being conducted by Tammy Bohm, CEP, who is a member of our Certification Council. So on level 2, 26% of your exam will be on equity plan design, analysis, and administration topics. You may see another question or two on admin. We've got, you have 110 questions on your test. 10 of those are experimental items that are not scored, and those are not marked on the test, but because of that, you probably will feel like you saw a little bit more than 26 questions in this area. One thing to really stress about this area is it's still important to read, outline, and understand the plan documents. The XYZ Equity Incentive Plan has been updated for 2019, so do not just stick your plan document from last year in your binder and think you're good. You need to reread it and re-highlight it. The Employee Stock Purchase Plan has not changed this year, so if you took level 1 in 2018, you should be safe continuing to use that version of the employee stock purchase plan only. But again, with the equity incentive plan, focus on the plan document that came in your 2019 binder. And then there are just a couple of other little notes here. And on that note, I will hand it over to Tammy.
Good morning, Pam. So we're going to start out with our overview screen, and these are just the different things that we're going to talk about in this level 2 administration webinar: change of control, early exercise provisions, evergreen provisions, performance measures, performance metrics, retirement policies and procedures, and stock swaps. So moving ahead, we're going to talk about the restricted stock. Restricted stock is awarded at no cost to the employee under normal circumstances. There are times that they do have to pay a nominal fee depending on the state blue sky laws and the par value of the stock. The restricted stock award, the restricted stock award itself is the grant of a share of stock. It is given to the employee at vesting for the full ownership, voting rights, and dividend rights. During the vesting period, the stock may be in the employee's name and held perhaps in an escrow account or at your transfer agent. But during the vesting period, oftentimes, because the recipient is an owner of stock, they will be eligible for voting and dividend rights. With regard to restricted stock and at this point, any transferring of data, you've got to watch for data privacy issues, especially outside of the US when sending information to transfer agents to issue shares. As I said, book entry accounts will often require a Social Security number in order for the shares to be recorded properly. You only want to send encrypted files. You may want to assign a unique identifying number when you send the shares over for book entry. Book entry is where shares are held at the transfer agent in the owner's name rather than perhaps in a stock account with a stockbroker or shares issued on paper. Restricted stock units, on contrary to restricted stock awards, are not actual shares, as you know. They are awards of units that will vest, where the stock will be given to the employee upon vesting. Prior to vesting, there are no voting rights, there are no dividend rights, there is no issuance of stock. They may be eligible, restricted stock units may be eligible for dividend equivalent rights, and often that's just a book accrual that would happen internally at the company, and the company would handle a payout, whether it was in proportionate shares of stock or cash at vest. I don't see this happen too often. It's complicated. It makes a lot more work for people. So restricted stock characteristics, we'll talk about the characteristics. Again, as I said before, they're usually awarded at no cost. If there's a par value associated with it, then there may be a minimal cost to the employee. Shares are often awarded for past services. The company itself has to determine whether it's going to be issuing shares from Treasury or from the authorized but unissued pool. This is an accounting-related activity that your accounting department would need to address. But note that shares can come out of Treasury as well as authorized but unissued pools. Shares are earned subject to vesting requirements, as we know. They're not transferable until vested. And again, we're talking about restricted stock awards specifically. They are subject to forfeiture if you terminate before vesting. And vesting may include performance criteria. So shares may vest in 3 years, but they may not vest at the end of 3 years if A, B, and C have not been met. Sometimes we can even see if A, B, and C are met, shares will vest at the earlier of meeting this performance criteria or 3 years time lapse. So when there's a situation where an employee is terminated, the company has the right to repurchase the stock that has not vested from the employee. And the repurchase would be at the lower of the employee's original cost or the current fair market value, but that's all subject to plan rules. If the company is privately held, then the company may have restrictions on disposal of the shares. It may have a right of first refusal. Privately held companies often have much different rules than publicly held companies on the repurchase of restricted stock at termination. Let's just make one note here that if vesting is accelerated per the plan document upon retirement, tax issues will arise when the employee becomes retirement eligible. Not necessarily when they're retiring, but when they become retirement eligible, there is a tax implication for both restricted stock and restricted stock units. Restricted stock requires the full taxes to be paid, federal, social taxes, at the time of retirement eligibility. And that could often present a difficult situation for the employee who doesn't have full access to the shares but needs to pay for their taxes on those shares. So just that's something important that you should be aware about. So stock swaps are a way that somebody can exchange shares that they currently own for shares that have vested, and kind of a net payout. So they're a way of exercising option, turning shares in that you already own to cover your exercise price. In practice, the option holder usually will attest to owning the old shares when he initiates the exercise electronically. And this way, there's just kind of a netting of shares in the end. The tax treatment of the stock swaps depends on the nature of the shares being swapped in and the type of option being exercised, which we don't technically test on until level 3. However, we do want you to understand the mechanics of stock swaps for level 2. So let's start with the example. And note, our examples are completely ignoring the fact that there is a tax implication as well. The participant delivers 400 shares. So a participant holds an option grant for 1,000 shares. The option price is $10 per share. Current fair market value is $25 per share. So the cost of the shares is $10,000, but the participant will say, okay, how many shares do I need to pay the company $10,000? Because the current value of the shares is $25, the participant needs 400 shares to pay the $10,000 cost. And as you see here, and then ultimately the 1,000 shares are issued to the participant. So the participant netting down their shares. They're giving the 400, they're getting the 1,000. It's actually increasing the number of shares they have, but it is adjusting by the number of shares that they had to swap in. Now let's look at another example here. So this employee, in this example, he owns 125 shares that he purchased on the open market for $10 a share. He has a vested non-qualified stock option for 200 shares with an exercise price of $5 per share. The fair market value today is $20 per share. Basically, this employee needs to swap in 50 shares to cover the $1,000 exercise price of the 200 stock options the person wants to exercise. That leaves her with what we call 50 replacement shares and 150 additional shares, plus the remaining 75 shares she didn't use for the swap. So remember, she owned 125 shares outright. She had to swap in 50 of those to acquire her 200 stock options. And so we've got 50 replacement shares, 150 additional shares, which those two constitute the stock option exercise, plus she has 75 shares remaining that she owns outright from that 125. It's important that you understand how these examples work, just real quick, so that you are able to quickly calculate if a question comes up on the exam. So we're moving on to the stock appreciation rights and the characteristics of stock appreciation rights. Companies sometimes use cash-settled stock appreciation rights, especially in countries where they can't make stock awards. A cash-settled stock appreciation right allows a participant to benefit from the increase in the stock price without having actual shares issued to them. So there's a vesting schedule. It's very similar to non-qualified stock options. There's a vesting schedule. There's an exercise in income recognition when the employee has the ability to exercise when they want to, subject to expiration of the award. There's no cash layout from the participant. Generally, stock appreciation rights will be paid in cash. I've seen them paid in shares or a combination of both. And they can also be in tandem with stock options. So let's say for example, an employee has a stock appreciation right for 1,000 shares with an exercise price of $10 per share, a market value of $25 per share, which, just as reference, is similar to the example we gave for non-qualified stock options a couple slides back. If they paid cash, they would receive the gain, $25 market value less the $10 that their stock appreciation right cost was. So the gain would be $15 per share, and they would get $15,000 in cash. If they wanted to or were eligible for shares, they would get the equivalent number of shares for that $15,000 for $600 in stock. And then the next slide shows how this is different from non-qualified stock options. So in this slide, you'll see the difference. Receiving an option provides for more options on what you can do at the end at an exercise, because most likely you're receiving stock on stock options, so you can exercise and hold, exercise and sell, do a partial sale. Here's where one person gets non-qualified stock options for 1,000 shares for $10 grant price. Exercises the option when the fair market value is $25 a share. We have multiple outcomes that are possible. She can pay $10,000 in cash and receive the full 1,000 shares. She can do a same-day sale and receive $15,000 in cash. Remember, we're not counting taxes here, which is the $15,000, again, is fair market value of the award minus the exercise price. or she can do a sell to cover and pay the exercise price using 400 shares and have the remaining 600 shares deposited into her brokerage account. Meanwhile, her coworker received a stock appreciation right for 1,000 shares at $10 per share. The coworker exercises at the same time as the employee with the non-quals did. Fair market value is $25 per share. That coworker only has two options, assuming the stock appreciation right can be settled in cash or shares. He either receives $15,000 in cash, the gain, or he can receive 600 shares. He cannot do a combination, and he is not permitted to pay the $10,000 to receive all 100 shares. And that's like a subtle difference on the SARS to stock option. Otherwise, they do have a lot of fairly similar components. Okay, moving on to performance plans, my favorite. So performance plans, PSUs, PSAs, DSOs, we're seeing them all today. Performance stock units. Performance stock units are similar to restricted stock units, but they have a performance component to them. It's a promise to award shares at no cost in the future, contingent upon achieving certain performance goals. Could be book value, total stockholder return. There's a variety of things that companies come up with as performance goals. And there's always a requisite service period as well. Performance stock awards, which are similar to restricted stock, just with performance criteria. Shares awarded at no cost, contingent upon achieving goals. When the performance goals and service period are met, the shares are released to the employee. Often the shares are similar to restricted stock awards. The shares are issued and outstanding. They're just restricted from being transferred or exercised or sold by the recipient until the awards vest. And then we have performance stock options, which could be a performance component tied to a stock option grant. And what I've seen is that a stock price hurdle, like the grant may be at $10 a share, but until the stock price is $12 a share, you're not allowed to exercise the award. That is basically the one performance stock option criteria that I've seen in the past. So we're going to move on here to plan provisions. And so now we're going to talk about plan provisions. There are a myriad of plan provisions that make up the overall stock plan. I call this the skeleton of the plan document. Change of control provisions, early exercise provisions. Under what circumstances can somebody early exercise? What happens when they early exercise? Same with change of control. What happens when there's a takeover of the company, a merger? People will think that if their company is acquiring another company, that's a merger and the change of control kicks in. But it's actually when your company is being acquired and your stock is potentially either being absorbed or going away. There are also performance measures, and they have to be defined in the plan, and they leave discretion to the board. If they leave full discretion to the board, it's a little bit more difficult to get a plan approved by shareholders. So most of the time, the shareholders want to see every performance measure that you're going to use under the plan defined in the plan. Let's see if there's anything else we want to talk about on performance measures. So historically, as I said, for tax reasons, they've always been in the plan. I still think that the shareholders want to see your performance metrics in the plan. And some notes about retirement here. Some plans allow for continuation of vesting or acceleration of vesting when an employee retires. This is also plan specific and a provision that is built into the plan. provisions related to retirement do have tax and accounting implications, which will be discussed elsewhere. But from an administrative standpoint, we'll go back to what we said. Read your plan, read your plan, read your plan. The plans have changed, as Pam said earlier, so make sure you're not using an old plan when you're taking this exam. One of the provisions that can be built into a plan, and I will say that shareholders and institutional voting organizations do not like, they're not real fans of, are evergreen provisions. An evergreen provision allows you to automatically increase the number of shares allocated and authorized for issuance under the plan on an annual basis. This is usually set up in a percentage format. There's usually a maximum number of shares that can be put into the plan. And the best thing that comes out of an evergreen provision is that it can alleviate plan shortfalls of shares so that you don't run out of shares in the middle of a plan year and have to seek shareholder approval in order to issue additional shares. But it can be very difficult to obtain shareholder approval on an evergreen plan. They just don't like it. They don't see any reason for companies to be increasing the number of shares available on a year-over-year basis without a full analysis. And for just a quick note on ISOs, if there is an evergreen provision that is tied to a plan that issues ISOs, they must state the number of shares that can be granted under the total number of shares ever that can be granted under ISOs. And this can be done with a percentage increase, or et cetera. But if the plan does not state the number of shares that can be granted as ISOs under the plan, then the evergreen provisions may not be valid. Okay, in provisions 423 plans, employee stock purchase plans that are qualified under Section 423 of the Internal Revenue Code and related dilution. So in level 1, we talked about offering period lengths and look-back features. Both of these affect how dilutive an ESPP will be. The longer the offering period, the more shares that get purchased, that dilutes your plan. A look-back feature can also contribute to that dilution, because if the stock goes up during the offering period, the participant is going to ultimately buy more shares on the exercise date, or purchase date, than they would be eligible to based on the current fair market value. So that's a look-back feature. The stock's at $8 at the offering date, it's at $10 at the purchase date. The employees are buying the shares at $8 a share. They get to buy more shares, they increase dilution. So I think I went through a second slide here. Offering periods, I kind of pretty much covered everything on this slide here in my discussion. Longer offering periods, just making sure I'm hitting everything here. And so I will move on to plan procedures and internal controls. Okay, we all love the Sarbanes-Oxley SOX 404 reporting. So this is all for plan integrity, making sure that everything is, then there's no funny business going on with numbers. Review third-party providers for adequate oversight. Our third-party providers will send us documents every year that show that they've been audited, where their audit shortfalls are, and those are part of their SOX controls. You want to make sure IT controls for equity comp, for the equity comp tracking system are accurate, they're secure. Depending on whether or not you have a web-based program or you're working on a desktop program, you want to make sure that your controls are in place and that the tracking on the system is accurate. You would like segregation of duties between award entry and award approval. So often what companies will do is one person, after the awards are approved, they'll receive a list. They'll upload the list to the software program, and then somebody else will kick out a report and review the list and compare it to the original approval to make sure that everything is exactly what it should be. We've got procedures. So you want to make sure you have procedures for communication. You want documentation of plan-related approvals, because when your auditors come through, they're going to ask you to see the plan approvals. They're going to ask you to see backup documentation from your board on the number of shares that were approved under the plan, assumptions for calculating accounting expense. They're going to want background documentation on that. That's a big one, because your accounting expense is your financial, it's your deductions, it's your cost, it's the overall cost of the company. So everything needs to be documented, and really it's just document everything, have a record of everything, because when you never know when you're going to need to go back and provide additional documentation and background or explanation, or the person who takes over after you. It's really helpful to have good records. We'll talk about grant procedures and internal controls related to grant procedures. Again, as I said, you want to verify before, when you're getting ready to have a grant and issue a grant, you want to definitely verify that you have adequate shares available in your granting pool, which means somebody should be watching the number of shares available for granting, the number of shares on reserve, the number of shares issued. You're also managing the terminations, and if the shares go back into the pool or they're retired from the pool. So there's a lot of dancing going on with the available shares, and it's really important to make sure that your authorized share pool has enough shares to grant the number of shares that you're granting in this round. You want to review your award terms, your recipient eligibility, your employee demographic. You want to make sure that your employee information is accurate when you move it into a grant system. You want to verify appropriate grant approvals, which means you want to make sure that the board or the board delegates have approved the grants, that that the approval is in writing, and that the grant date is verified. So you want to advise your transfer agent of these awards. I think we switched slides. No, verify your transfer agent of the awards, because the transfer agent needs to will ultimately need to issue the awards when they're vested. Notify the grant recipients. Grant recipients should be notified within a week or two after they are given an award, because if you wait too long, it will have an impact on accounting and grant date. Most companies collect grant acceptances today. I think that companies want the grant acceptances, need them. If you don't accept your grant, often, say after 90 days, companies are just going to terminate the grant and not give it to you. And you want to review whether appropriate disclosures sent to the grant recipients, such as the prospectus and similar documents, as well as the grant agreement, etc. And you also, it's really good to have a place where these documents are available for the recipient to access anytime, especially the plan prospectus, which is a Q&A for them to go back and try and understand what they've been awarded. Transfer agent's role. It's really, really important to have a relationship with your transfer agent. The transfer agent holds all the shares of stock. They can fix the errors when there's an error on the number of shares issued, the number of shares authorized. They can fix your escrow accounts that hold the shares that have been approved for issuance under equity plans. So you want to make sure that you do have a relationship. But in this situation, the transfer agent, they register the issuance. they're the controller of the transfer of the shares ultimately. How many shares are outstanding, how many shares are issued, how many shares are in reserve. They also do the record keeping. If the participant chooses to hold the shares in their own name, the transfer agent is the conduit for them to work with in case there are balance issues or dividends, they're not getting their dividends, etc. And again, as I said, the transfer agent is also the one who handles returning pool shares to the pool, repurchase shares going back, communicating with them whether they're retired shares or they're just going back into the pool of available for issuance, etc., is really important. And also, when a company withholds shares to cover taxes, the transfer agent will also be active in most likely moving the shares withheld for taxes to a treasury account. The transfer agent is the manager of the treasury account as well as the other accounts that have the ability to issue shares into the open marketplace. And international labor law considerations. The biggest thing today is that international labor laws consider, this consideration of international labor laws comes into play on level 2. We won't test on specific country rules, but you should look at the issues that arise and what we're dealing with regard to equity plans outside the U.S. In some countries, equity compensation can be considered a right to salary, which gives an employer much less discretion than they have in the U.S. Because if we are in a country where it's akin to a salary, then the employee is expected to get that award every year. Now, in the U.S., for example, an employee stock purchase plan can become a non-discretionary acquired right, which means that the company could need consent from the employees if it wants to change or terminate its ESPP. Again, this is under labor laws of varying countries. In fact, ESPPs are more likely than any other forms of equity to be deemed to be an acquired right because they are broad-based, ongoing, and typically funded through payroll deductions. So if an employee is fully participating in an ESPP all the time, and all of a sudden the company decides to cancel it, terminate it, this may present a labor law situation in certain countries, just because the employee was relying on that income. As far as data privacy goes, I think we all know about GDPR and major data privacy issues with various countries, especially in Europe. It's at the top of the discussion today. And even in the US, data privacy rules are starting to come into place. But there are rules that restrict transfer of information between corporate entities, countries, and service providers. And companies really need to be aware of these restrictions so that they follow local laws, especially given the weakness of the current US data privacy.
All right, well, thank you, Tammy. For candidates who are interested in additional courses that may help with your exam preparation, we've listed a couple of options on this slide. We've provided this exam overview webinar to assist you in your exam preparation, but in and of itself, it's not sufficient exam preparation. I just want to gently remind you that all of the test questions are developed exclusively from the CEP assigned materials, and you should thoroughly study those materials. That's what the questions and answers are based on. This webinar will be available to you for unlimited viewing between now and the exam date, and the same is true of the webinars for the other topics on the exams, and also the other exam levels. And on that note, thank you, Tammy, and good luck on the test, everyone.